Hi, Mark. How are you?
Nadia, happy Thursday. How you doing?
Happy Thursday. It's our podcast time.
Always an exciting time for Bridgepoint, and we're delighted to have everyone show up and enjoy, hopefully, all the exciting things we have to share. Nadia, how's
Yes.
your day?
So, Jerry, if you don't mind, just let's dive into it and let's go to the next slide. So, as usual, we have a disclaimer. So, just keep in mind this is not financial advice, this is not investment advice. We do this every week. We try to educate the market. We talk to our investors all the time, similar to a session like this. And we're just doing a recording session to make sure more people can see this and get some key takeaways and benefit from this. Let's go to the next slide. So different from normal, what we normally do is to have the speakers on a show. But today we kind of want to do a year-end roundup. A lot of things going on in the market. So we want to talk about some of the interesting news and events, and help our investors to make sense of things. So we have Mark and myself on the show, and we will kind of just run through the year-end roundup of news, and also talk about what you should do with your taxes and also investment strategies going forward. Next slide. So I kind of mentioned already, but this is our agenda. We will first talk about the events happening in terms of the macro economy. And also next we'll talk about the cash flow investment opportunities. Yield is very important for investors recently. So we want to talk about a couple of strategies there. And finally, we'll get into the investment planning and tax planning a little bit as well. Anything you want to add, Mark?
I'll just say a couple quick things. We'll dive into them shortly, but the macroeconomic environment is becoming more and more, I'll say, challenging for investors. The Fed raised rates yesterday. We'll talk about that. Unfortunately, there's a war going on between Russia and Ukraine, which continues to create stress in the markets. We had in China, I'll just say, the reappointment of President Xi for another 5 years, which, by the way, is 5 more than he should have had when he started. So there's a lot of things happening right now. The China-Taiwan situation. So I'll just say, and by the way, we have an election in the U.S. midterms next week. And the likelihood at the moment is the Republicans are going to take the Senate and the House. So there's a lot of things from a macro investment perspective that are going to have a dramatic impact on investment returns, and including the Fed yesterday.
Well said. So yeah, let's dive into macro economic matters. So I just want to take a moment to look back a little bit. Mark, back in spring 2020, when the pandemic first hit, did you ever expect we're going to have inflation back then?
Well, I know the most dangerous words on Wall Street are the dangerous words of forwards. It's different this time because it's not different. The economies go through cycles, investments go through cycles. So the period you're describing was a period of deflation, which has been a real exception to the economic cycles in the US, where it's been more a case where we have inflation. And when we had deflation, you had aggressive moves, both from a fiscal policy standpoint and a monetary policy standpoint. So what were some fiscal responses to the deflationary crisis triggered by the COVID crisis? Well, firstly, there was stimulus checks that everyone got. It was massive infusion by the government to keep the economy, I'll say, fully employed. So that was a big impact from the fiscal side, which, by the way, dramatically grew our deficits. Important thing to remember. And then secondly, on the monetary side, the Federal Reserve slashed interest rates to zero. It was really like giving away free money. Now, that will never last forever, and it didn't. If you remember last year, the Fed was talking about inflation being what they called transitory. which was a new word. It's not something I ever saw in my academic training. Nadia, I don't know if you ever saw them use the word transitory connected with inflation, but I never did.
No, I didn't either. So here we are towards the end of 2022, and everyone's experiencing the pain of inflation. And of course, the Fed is trying to curb that. And yeah, you talk about yesterday, another 75 basis point of rate hike. What do you think is going to happen next? Do you think the rate hike is going to be 50 bips potentially?
Well, two things. That's at the moment, and I have to say at the moment because it changes every day, just because that's the way the markets work. At the moment, that's the expectation. The Fed will start to, say, dampen or slow down these aggressive rate hikes. So at the moment, December 50 basis points is more or less what the market currently expects. The fact it goes from 75 down to 50 is because the market believes that we're finally, with these rate hikes, seeing signs the economy is slowing down and that inflation will get back under control. Just remember, the Fed's mandate for inflation is inflation between 0 to 2%. And that's their target. But the actual inflation rate that we've experienced is 40-year highs. It's over 8%. So we're way, way above target. So
yeah. So Jerry, if you don't mind, go to the next slide. The CPI numbers.
Yeah, and I can tell you this much. When you have inflation in the system and it gets embedded, it's really hard to get it out because people expect it. It gets built into wage increases. It's embedded in the retail market because people are conditioned to think every time there's a new invoice, prices will go higher. So it becomes a spiral. So it's very important to nip it in the bud when you can. That's why when the Fed said transitory last year, which really was not the case, and now they're being taken seriously. But I just want to say one more thing. At the moment, the U.S. has the luxury, and I emphasize luxury, of being the reserve currency of the world. Because when you're reserve currency, you can have massive deficits, but it doesn't matter because everybody needs your dollars to transact in the global economy. Well, if the Fed loses its credibility as an inflation fighter, then the U.S. status as a reserve currency is in jeopardy. And right now, we've had lots of benefits by being the reserve currency of the world. So the Fed really can't relax on their inflation fighting mandate.
So what about the financial markets? So we all know the increase of rates will definitely impact the debt level in the financial markets, and we are beginning to see some signs of potential crisis for some of the large financial institutions. What do you think is how to balance that? What's your view on this one?
Well, firstly, it's my humble opinion that most financial crises and really recessions, the heart of what triggered those things was the banking system or the financial markets, the capital markets. So if they seize up, the market really depends on the free flow of liquidity into the market to run a successful economy. So on that point, it was late last week that Credit Suisse basically announced their earnings, or I should say lack of earnings, but this is a stock that people are comparing to Lehman Brothers from 2008, and Lehman was the final trigger that triggered the financial crisis that affected the global economy. So you can't look at a major bank like Credit Suisse and say, oh, it's a one-off thing, they're going to get bailed out, no harm, no foul. It doesn't work like that because these banks all lend to each other. There's counterparty credit risk, and it's just a really delicate, fragile situation.
So in terms of how much the Fed should be raising rates and how to balance with the financial market and financial institutions, there's another important thing people are looking at, which is employment. Right, so we all know employment is still looking very good right now, but there are signs from big tech. People are starting to worry, especially with the Q3 earnings coming out last week. The results are not looking great, and we all know Musk just bought Twitter. By the way, I will be asking you about your view on this one as well. But they just announced they're cutting 50% of the workforce. Meta is that definitely laying off people as well. Even Google launched the performance improvement program. So it seems like all the big tech are starting to laying off people or putting hiring on freeze. So where is the turning point? Where do you think the Fed will decide, okay, this is the time?
Well, firstly, the current expectation is that the unemployment rate at currently around 3% needs to be at 4% to give reduction in upward pressure on labor rates. So we're at 3 and we need to be at 4. Now, you mentioned the tech sector, and yes, there's future labor slack in tech because for 2 reasons. One, they got, frankly, I'll just say, overstaffed. And now the future prospects are not as exciting as they were, so they're overstaffed. So they needed to cut, and they are cutting. Frankly, they probably should have had that discipline before now. But as Warren Buffett likes to say, when the tide goes out, you get to see who's swimming naked. And that's frankly what's happening in tech right now. The fact that at Twitter that Musk thought they were 50% overstaffed, that's shocking. 50%.
Right.
But the question is, how do you go from 3 to 4? The tech sector alone is not going to get us there. So, but the multiplier effect of the tech employees rather, they're very highly paid. They spend a lot of money, and they have multiplier effect in the rest of the economy, whether it's the dry cleaner, whether it's the gardeners, whether it's the restaurants. They spend a lot of money and they feed a lot of things. And they're clearly on the defensive now. And that will show up in the real economy, but on a lagging basis. And this is really the challenge of the Fed, because the medicine they're injecting of higher rates to slow the economy, it takes time for those things to take effect. And that's why their track record of raising rates and engineering soft landings is so poor, because what they're trying to do is almost impossible to do. Raise rates, stem inflation, and not have a hard landing.
Right, there's definitely going to be ripple effects. We're starting to get some really good questions, so let me just mention a couple of them. So since we're talking about the Fed has a balancing act, this question is from John. So he said the Fed has a balancing act to keep the economy from heading to a recession. I have heard they acted too late and not too aggressive. Do you agree with this?
Well, I think it's fair to say they acted too late, because transitory is not something they mentioned in 2022 anymore. So they were dead wrong about that. So yeah, they should have raised rates starting last year. And the problem is, the longer you delay taking the required medicine, the worse the medicine has to be to cure the patient, or in this case, get inflation back under control. So they definitely were too slow to act. But the question is, how far are they into curing the patient of inflation, and how much more they have to do? That's the magic question that everyone's trying to figure out. I know a lot of people think that we're near the end of the cycle, and I know other people think that this is going to be something that's going to be with us for a while. So it's hard to imagine 8% going back to 0 to 2% without having an ugly recession at this point. I just don't see it.
Right. So speaking of recession, let's talk about the big tech earnings a little bit. So yes, we're switching gears a little bit, but also related. What's your views on those earnings? Do you think this is impacted by the advertisement? A lot of companies are cutting their budget on the ad spending. How do you interpret all these earnings?
Well, earnings or lack of earnings. But you're making a great point about advertising. If hypothetically ABC company and I'm advertising on Google, just to pick an example. Well, if my future demand is declining, I'm not going to spend as much on advertising going forward as I spent before when the economy is expanding, because it's a waste of money. And then secondly, advertising, yeah, it's important to keep your sales and your sales pipeline growing, but short term, you can underspend on advertising, it won't show up in the numbers. So it's a dangerous game if you do it on a permanent basis, but on a short-term basis, you can massage your earnings and look good by slashing your advertising. So a lot of the big tech companies, basically, they make a lot of money through advertising. So this is having a huge impact on that sector for those reasons.
Right. And Mark, this leads me to ask you about the deal that's in the headlines, which is Elon Musk buying Twitter. And we all know Twitter is in a lot of debt. They are laying off a lot of people to reduce the cost. And there are a lot of other things Elon is trying to do to turn it around. Do you think he can do it? What's your view on this deal?
Well, firstly, look what's on his plate. He's running Tesla. He's running SpaceX. I could name 3 or more companies that he's heavily involved in. Unless he clones himself, I don't know how he can do it all. And all those different companies have their own unique challenges. But this is where he's at. And did he overpay to buy Twitter? Time will tell. My instinct says yes, but by slashing half the workforce, will he permanently damage the Twitter brand? Who knows? I don't know. But it's definitely a risky situation that he's put himself in.
Okay, it doesn't sound like you are too bullish on this deal, but we'll see.
I'd be shorting it if I was the hedge fund right now.
Okay, so we are going to talk a little bit about international situations as well. You kind of mentioned it a little bit at the beginning, but we do a lot of cross-border, deals and transactions at Bridgepoint, and we do talk to Asia quite a bit. We just had a podcast on Singapore 2 weeks ago, but too many things are happening right now in China, in Europe, even Japan. Where do you want to start? Your pick.
By the way, those 3 items could be 3 separate podcasts of an hour apiece. So whatever we say will just be touching the surface at a high level. We won't really do it true justice. But why don't we start with Asia? So we obviously had an important event in China last week where the political system, I won't get that word right, but basically had their annual or their 5-year meeting, and President Xi was voted in for another 5 years. By the way, when he started, he was supposed to only have 2 terms. He's at 3 right now. So just that's an important data point. I think secondly, he surrounded himself, and this is the Western interpretation of what he did, but he surrounded himself with very, very loyal people that are loyal to Xi. And they tended to be older, an important point, because it's the younger up-and-comers that can challenge his power base. But he doesn't have that. The former premier was literally escorted out of the session on the last day. And that was very symbolic. That was, I think, a way for Xi to signal to everybody, I'm in charge, guys, and don't mess with me. So that has lots of ripple effects. From a, I'll say, geopolitical perspective, one ripple effect, and I want to be wrong, is that the tension between China and Taiwan is only increasing dramatically. Mm-hmm. And again, I don't really want to march down that path on this call because it's too complicated. But there's clearly political tension on that front. And on top of the China situation within Asia, you mentioned Japan. Well,
Right.
the dollar yen exchange rate right now is at 150. Record highs. And a few things. The US, as I started to say before, is the reserve currency of the world, and the Fed is the central bank of the world. As they go, the rest of the market, if they follow suit, okay. If they don't follow suit, they're punished. And
Right.
that's certainly what's happened in Japan. And I've heard rumors, and they're probably correct, that the Bank of Japan has been intervening quietly or stealthily in the foreign exchange markets to try to stem the rapid depreciation of the yen. Well, two things. The currency markets are bigger than any central bank. So all they're really doing is slowing the pace of depreciation and making money for the speculators because they're making an asset more cheaper than it should be, and the speculators will capture that benefit. So it's not a good situation, but that's what's happening in the currency markets in Japan. And just remember, and this is what I'll call unintended consequences, but with what the Fed is doing, now you're seeing cracks in the foundation. Japan is a very important trade partner and very important political partner, someone we don't want to screw up their economy, and we're very close to doing that.
Well, I think Japan is a very good example of showing just by printing money is not going to solve everything, right? That's a classic example. What about Europe? Europe is complicated, of course, because there's a war going on. Germany is in a little bit of trouble. UK, of course. Give us your rundown on your views, in Europe.
Well, I'll just use a silly example, which I think will speak volumes what's happening there. But many Europeans are expecting to have no heat or power come December, January, because they expect Russia to turn off the flow of natural gas and oil into the European economy. So they're hoarding wood, but they can't get enough wood to heat their houses. I mean, that's how scary the situation in Europe is. And on the back of that, speculators see opportunity in good markets and bad. The speculators now are massively shorting European stocks. They're shorting the euro currency, and they're making a lot of money. I'll just give you one example, and this is not based on any knowledge of their positions, but two data points. One, Bridgewater for the first 6 months of this year was up over 30%. And I do believe a good portion of that gain was associated with shorting Europe. So that's an important point to remember. And secondly, Brevan Howard, another large hedge fund headquartered in Europe, in the last 30 days was up 10% in a month. 10% in 1 month. And the same thing, I guarantee you they were shorting Europe because it's been a one-way bet. So with the war going on with Russia and Ukraine, which, tell me when that's going to have a positive outcome, because Nadia, I don't see it.
It's a lose-lose situation.
Exactly. So, there's rumors that Russia's been considering using tactical nukes as a way to deal with the problems they have with Ukraine, which, is a very, very scary thought to even mention, but that's the macro environment we're operating in right now.
What about UK? Obviously, a lot of news there too. The shortest term of a prime minister and now the new one. Anything you want to share with the audience on that front?
Well, firstly, I did live in the UK for 5 years. So
yes.
I think it's a great thing, but I think it's also funny in a way that they have an Indian prime minister. I think it's a great thing for diversity and, frankly, picking the most talented people. And all indications are that this new prime minister is extremely bright and talented. So I think those are net positives. But knowing the local hardcore Brits that I know, they must be, having anxiety attacks over the change of regime. But I think medium term, I think it's a good thing.
Well, wait and see, right? He just needs to last for more than 44 days to not be the shortest term. Okay, we have more questions coming in. This one is related to foreign exchange. So what is the consequence of extremely strong dollar and declining value of other currencies?
Well, firstly, U.S. corporates, particularly S&P 500 U.S. corporates, earn at least 30% of their revenues and profits outside the U.S. So when they do the quarterly and annual scorekeeping of how they did, they're returning discounted currency in the dollars to do the scorekeeping. So net, it's actually harmful to their P&Ls because the stuff they're selling abroad, when they consolidate it, it's not worth as much. So that's just one example of the strong dollar. Emerging markets, I lived and breathed Latin America for many years when I invested in private equity Latin America with Catterton Partners. And the expression we used was when the US sneezes, Latin America catches the cold. So they're having a lot of problems with their currencies, which is leading to, record high inflation and hyperinflation in places like Argentina because of the strong dollar policy and rising rates. The thing that I want to emphasize, yes, the US central bank is the central bank of the world. Okay, fine. But individual countries have their own unique fundamentals. And if they have to track what the Fed is doing, which may or may not be what is appropriate response to the local economy, it makes matters a lot worse. And every global country doesn't have the same economic situation the US has, but they're forced to follow it. A good example is Hong Kong. Their monetary policy, because they pegged to the dollar, when the US raises, they raise. And again, it's causing a lot of economic damage.
So Mark, we'll go back to the raising interest rate and also inflation and how to deal with that more practically for our investors. But before that, I do see another question in terms of gold. Do you think gold is a real inflation hedge?
Well, I know this much. If you look at the charts of any reasonable period of time, when the dollar goes up, gold goes down. When the dollar goes down, gold goes up. So it's really a proxy hedge for the currency. Yeah, people like to think it's a gold inflation hedge, but clearly this year inflation's been really high and gold is not high. It's actually weakened. And I believe it's because the US dollar on a trade weighted basis is up over 10% this year. So the need to own gold as a store of value, it hasn't been there. You could hold the dollar and be better off. So people have also said that crypto can and should be a better way to hedge inflation, a replacement for gold. And that really hasn't been the case either. It's really been what they call a risk off, risk on trade. When equities go up, crypto tends to go higher. And conversely, when equities go down, cryptos tends to go lower. So it hasn't been inflation hedge. The one thing about crypto versus gold is a physical asset. You have to store it, you have to watch it, you have to protect it. So it's not an asset that doesn't have a cost to carry to it because you have to store it and do all these things. So if the price doesn't go up, you're losing money with gold because you have to store it. With crypto, it's a digital asset, so you don't really have the same problem. But it's too new to know whether over time it will be a replacement for inflation hedging that gold's traditionally had.
Terry, if you don't mind, let's go to the slide where it shows the Bitcoin and Ethereum price data. So this is actually a little bit outdated because we put the slides together a couple of days ago. But for the recent 2 months or so, couple months or so, you can see on the chart is actually pretty flat, given the volatility on the market, the stock market, bond market, et cetera. Cryptocurrency is actually less volatile to our surprise. And Mark, we kind of talked about this a little bit. Why do you think this is happening?
Well, it's ironic that crypto would be less volatile than stocks when you just think of that comment, but yes, that's the case. I think firstly, people who own crypto, and I'm making a massive generalization when I say this, but to a large degree, they want to get rich quick. They want to make money. This is not, for them, a long-term buy and hold. Generalization.
Although that's changing a little bit.
I agree. But for those that are trying to earn a return on an asset that's not moving, one thing they can and do to earn return is they sell volatility. So you see this chart here and look at Bitcoin. It basically is flat for 2 months. So why would investors in Bitcoin sell volatility, and why did that cause the curve to be flat? Basically, if I own Bitcoin, or Nadia, you own Bitcoin, you can sell puts and calls to earn premium, which generates a yield for you and a return for you. And if the currency doesn't move, you collected that premium, thank you very much, and you still own your Bitcoin. Well, I believe that's what's really created this low volatility in crypto at the moment. Now, that being said, it's like a spring that compresses. So a spring, when it compresses too much, it breaks the other way. So yes, this is what's happening, but it's not going to stay here. Now, the question is, when does it break out of the trading range and does it go up or down? I believe that if we can get clarity from the Fed with their future rate hike strategy, that will trigger the breakout either up or down in Bitcoin.
Well, we all hope we have the crystal ball, right? But I get the concept. A lot of people are writing puts and calls, and that's why it's only moving within a certain range.
Exactly.
So let's go back to the interest rate inflation, and that's kind of our favorite topic right now. But we want to be a little bit more practical to help our investors. So the next section, Jerry, if you don't mind, go to the next slide, is to talk about what kind of yield generating, cash flow generating investment opportunities are out there. And I saw some data from Bloomberg. The 10-year treasury price is at record low since 1788, but the yield is record high. So maybe it's time to allocate to bonds. Can you talk about that a little bit, Mark?
Yeah, when you talk about bonds, there's many dimensions to them. Firstly, where on the yield curve do you want to own bonds? You can buy 10-year bonds. In the case, most people really watch the 10-year treasury yield because it affects so many things in the economy. As an example, mortgage rates are priced off where the yield of the 10-year treasury is. So that's a really key data point to watch. But the longer out you go on the yield curve, the more price risk you have in the bond you bought. If you buy something that's short end of the yield curve, that means it's going to mature in a short period. And when it matures at par. So even if rates are going up, the price sensitivity of what they call low duration bonds, which means lower maturity risk, those bonds are more stable, less volatile. And in markets where there's uncertainty, remember, markets can take good news, they can take bad news. It's uncertainty they can't take. And we've just outlined a lot of macro themes that have a lot of uncertainty connected to them. So in this environment, I'll just say playing defense, not offense, is I think a prudent way to go. So then the question is, where on the yield curve should you be investing? A lot of people are looking at the 2-year point of the curve, which is almost like cash. So that's very, very low maturity, but you can earn 4% in the 2-year portion of the curve. And if you put your money in a savings account, yeah, we just raised rates 70 basis points, but The savings accounts aren't anywhere near 4%. So that's a pretty good place to park money in this uncertain period.
So give us some examples of asset classes, and of course you mentioned the shorter duration bonds already, but are there other cash flow investments, asset classes people should consider?
Well, firstly, let's break it down into the instruments. So exchange traded funds are a very innovative and efficient way to own assets. An ETF has a very low expense ratio, which expenses are a zero-sum game. Either you pay them or you don't pay them. So you really want to minimize expenses on your assets that you buy. So ETFs have a very low expense ratio. Secondly,
Mark, sorry to interrupt you, but you were talking about the treasury ETFs, right?
Yeah, as an example. So they have obviously low expense ratios. By the way, this chart is an extract of what was in, I believe, Bloomberg last week. So these numbers are already out of whack because the Fed raised rates 75 basis points yesterday and price moved literally every second. But it gives you a pretty good idea of what's going on. So if you look at the first item in there, you have the 1 year portion of the treasury curve. So the midpoint of 1 to 3 is 2 years. So use that as just a placeholder. And you can see that part of the yield curve for treasuries is up about 4.7% this year. Now you might say that doesn't make me excited. Well, if you compare up 4.7 to NASDAQ, which is down at least 25% this year, that's—
By the way, this is down 4.7.
Oh, it's down
year-to-date return.
My bad. Yeah. Okay. On a relative performance basis, I'd much rather be down 4.7 than 25. So it's been a better place to be, even though it's negative, unfortunately. But its current yield is about 3.6%. So again, bonds basically mature to par. So the likelihood you're locking in 4% rates for the next 2 years by buying this. So again, very conservative. It's a government-backed counterparty. You're not going to lose your money, and it's a safe investment. If you go further on in the yield curve, 7 to 10, you can see it's highly sensitive to interest rates. Not surprising, its return year to date is down 17%, almost 4 times what the 1 to 3 year part of the curve did. And its current yield is 3.3%. So if you can determine when the Fed's going to stop raising rates, that's a great time to go further out of the yield curve and speculate on price appreciation of these bonds you bought. But right now, people don't know where the Fed's going to stop, and they're very fearful. So better to be cautious and be at the low end of the yield curve.
So in summary, people should, of course, think about the counterparty risk when they are selecting the right product, and of course the duration of the bonds, and look at the yield as well. And no one can be the worm in the Fed's stomach, but try to understand the policy from the Fed and see when they're going to stop raising rates. Okay, got it.
Yep. Put that on a poster and read it before you go to bed every night, because that what you just said is exactly right.
Or just listen to this podcast every night. I know people are not going to listen every night. But what about municipal bonds? Are there certain advantages people should consider that?
Well, firstly, yes. Secondly, municipal bonds are tax advantaged. So when you look at the yield of a municipal bond, it's really an after-tax yield, and all these other yields you're looking at are pre-tax yields. So to make them on an apples-to-apples comparison basis, either put a tax charge on those bonds that are taxable, or gross up the yield of a muni bond to its pre-tax equivalent yield, so you can compare an apples to apples. So muni bonds basically have 3 benefits: federal tax exemption, state and local exemption, depending on what munis you buy and where you live. So Nadia, you split your time between Florida and New York, but if I can just use last year as an example, your tax residency was New York City. So your marginal tax rate is very, very high. So putting money in a New York municipal bonds saves you 3 levels of tax. So for you, owning munis is very, very compelling. And investors really have to keep an eye on what their earnings are after taxes, which we'll talk about in a short period about year-end tax planning and things that are proven effective to minimize your tax burden. Because just like expenses in investments, that's a zero-sum game. Either you pay them or you keep them. The same applies to your taxes. You have every right to minimize your tax burden. And there's some easy to implement, proven things to do to keep your tax burden as low as possible.
Great. We'll get more technical in terms of tax planning, but let's finish talking about the yield curve here. So by looking at the yield on this chart and comparing to the previous slide, they're not much higher. So tell us a little bit more. How do we consider preferred stock ETF, dividend stock ETF versus municipal bonds and treasury bonds?
So I'll use a silly example. No, I'm going to forget the example because I screwed it up already. Basically, there's different instruments that have different risk and returns associated with them. So a stock has a volatile stock price.
Right.
And at the moment, because stocks have had a poor performance, the dividend ETF, you can see here, has had a lousy return. It's down 16.5% this year. Now, you compare that to muni bonds, which are tax advantaged, and you have half the loss. You're at 10%. And then you have preferred stocks. And remember, preferred is really a hybrid security that sits between both debt and equity. And at the moment, the yield on a preferred looks pretty good. It's 5.6% versus dividends at 1.9%. But when markets start to rally again, and at some point equities will rally again, it will be in our lifetime, I promise you, Nadia, stocks will outperform preferreds because it won't have the same price opportunity associated with it. So net, there's a reason why the dividend yield is low and the preferred yield is high, because one gives you current return and the other gives you a combo of current return and future return through price and stock appreciation.
Jerry, if you don't mind, go to the next slide. Couple more cash flow opportunities. These are corporate bonds and REITs as well. Any suggestions on these ones, Mark, when selecting asset classes to allocate?
Well, firstly, let's look at the first item on there, the Bristol Myers Squibb stock, and its return year to date is up 15%. Every other item we've looked at so far has had a minus sign in front of the number, and this is actually a plus in front of the number. So question is, what was happening? With Bristol Myers Squibb, it gives you a nice dividend yield as well, 3%, but why is Bristol doing so well? Well, firstly, when you have an economic cycle like the one we're in now, things like healthcare tend to be a store of value for people. People get sick in good economic times and bad economic times. So healthcare in the current environment tends to do well. I'm sure there's product approvals that I'm not referring to that also help boost the share price of Bristol Myers Squibb. But bottom line, you can see if you pick things like stocks, you get the benefit of the dividend yield as well as the price appreciation, which is what happened here. Sempra Energy, again, if you look at the performance of commodities in an inflationary period, which we've been in, oil's done very well. We like to talk about the Goldman Sachs Commodity Index as a core investment to handle your inflation risks in your overall portfolio, which remember are paper assets. Paper assets poor with inflation. commodities are a real asset, and they tend to do well with inflation. So net Semper Energy is energy, and it's up 19% year to date because oil's up, and you also get the fat 3% yield on it.
So just want to put a disclaimer there. We advocate diversification as always. These are just examples to pick the right sector, to look at the financial economic cycle when you are picking, well, not really picking a specific stock, but when you are allocating to the right asset classes. But these are just examples. So let's touch on rates a little bit. And we do want to get to the tax planning technical stuff as well. So rates, right, very complicated. The year-to-date return is not looking great. And in terms of the general market, because of raising mortgage rate, housing is going to be impacted. So how do people look at this versus the yield that these assets are generating?
Well, you mentioned 10-year rates, you mentioned real estate, and now we're looking at the REIT, which stands for Real Estate Investment Trust. This is the sector of the stock market dedicated to owning real estate assets, which are highly sensitive to fluctuations in 10-year treasuries. And look what the return is for this REIT. It's down 37% for this year. That's pretty devastating. Even though its current yield is 3.4%, it's been really negatively affected by rising rates. And you can see the second one, National Storage Affiliate Trust, basically with real estate, you have commercial, residential, things like warehouses, all kinds of stuff. But no matter what you touched on the real estate investment trust side, you got your fingers burned. All of them look really horrible.
Mark, we did mention iBond a little bit, and this is a question coming from Jerry. There is an opportunity on iBond. Of course, it's kind of missed out because the yield is 9.62 because of the cycle that the Fed is adjusting the rates, and that's kind of packed with the iBond, but there's a lag for a couple of months. The iBond, I'm kind of just answering Jerry's question here, yeah. But the maximum is $10,000 per SSN. So it is generating actually zero real return because it's directly linked to the inflation. So if you're considering inflation, of course, it's no risk and no return, but it's generating that yield to offset the inflation. So it's actually a very good place to be when it's high inflation. Unfortunately, the cap is $10,000, but it's definitely something people should consider when in a high inflation scenario. And the question from Jerry, and this is the last one I promise before getting to the tax stuff, is are there any other low risk and high return financial products people should consider or worth looking into, so people don't miss the opportunity again?
Well, the simple question with a not so simple answer, but ultimately it starts with a top-down, in my opinion, asset allocation. And it's my training and belief that trying to time the market and chase the latest trend, you're always going to play catch up and you're going to miss it. It's extremely, extremely hard to know when to sell and when to buy. Those are two decisions you have to get right when you're doing the market timing play. So I don't believe in that. So my training and my belief is to have an all-weather portfolio that basically anticipates all these things we're talking about. So just really simply, every portfolio is essentially paper assets. So you should have protection from inflation, which will negatively affect your paper assets. So I advocate the Goldman Sachs Commodity Index as a core holding because it does extremely well in inflation. Last time I checked, the Goldman Sachs Commodity Index for 2022 was up over 25%. Yeah, half of that allocation is energy, and energy's done well, but it has other core holdings like copper, wheat, et cetera, et cetera. So it has other commodities as well. So asset allocation top down, definitely. So that's inflation protection. I believe for deflation protection, which is the opposite of inflation, 10-year treasuries does the job. And you can look at a lot of financial crises, et cetera. You enter periods of market dislocation, the risk off trade, people are buying either cash or 10-year treasuries. That's where the money goes. So those to me are very core holdings. On the equity / growth side, it's really two things in my view. One, it's the stock market through ETFs, because that's the cheapest way to own them, but it's the global stock market. Don't have an opinion on any one sector, own all of it. And the non-ETF public listed stocks, it's my opinion that should be addressed through things like venture capital and private equity. And that's frankly a business that we're in and we advocate, but we're one of many. And if you do things like venture and private equity, you 100% need to diversify it. Never, ever put all your eggs in one basket. You have to own a basket of things because there are always unforeseen circumstances that can disrupt what you thought was a good idea. So that's
well
three.
Said.
And then lastly, if you can avail yourself of these things, market neutral hedge funds are also a great way to, I'll say, outsource the market timing, which can and should be done, but let the pros, the experts, live and breathe this stuff and have information advantages and technological advantages that you don't have. So I mentioned Bridgewater 6 months into the year was up over 30%. I mentioned Brevin Howard last month is up 10%. Well, guess what? They have the information, they have the technologies, they can trade in milliseconds, where if you pick up your phone or press the buy or sell button on your computer, you're a million miles behind what they just did. So let them do it for you. So those are, in my opinion, the elegant way to build an efficient portfolio.
Great. You actually answered a complicated question pretty well. Well done on that front.
It'll never happen again, don't worry.
Jerry, if you don't mind, go to the next slide. Yeah, so we covered a lot already on this call, but we have a little bit more, a bonus point for all the audience here, to save some tax dollars at the year end. And there are some tricks that we know how to play. So just a couple of tips. Next slide. So yeah, a lot of things on this slide, but Mark, just give us a couple of examples of the things that jumps out.
Well, I'm going to give you a real life example. So to those that are not aware of it, at a different point in my career, I oversaw the global private wealth practice for the McKinsey and Company partners, of which there are 3,000 of them in 50 countries. So there's a big pool of, I'll just say, clients that are very demanding, very smart, and we had to deliver effective results. So on the tax planning side of things, and it also relates to investing, what we did, just hypothetically, everyone did a tax return last year. And now we're at the end of this year. Simple thing to do, and it works really well. Take your last year's tax return and just write down on the margin in pencil what you think this year's numbers are going to look like. It's an estimate. You don't have to be perfect. But when you do that, a few things will jump out at you. Firstly, do you owe state income taxes this year at the moment? Yes, no. If you do, in all likelihood, you should pay that state income tax estimated payment now because you can deduct it for federal income tax purposes. So you can capture a tax deduction that you wouldn't capture otherwise if you didn't take this approach. The same thing with property taxes, the same thing with gains or losses in your equity portfolio. So this gets back to a concept called tax loss harvesting, which you've heard in the news quite a bit, I'm sure. And this year, there's a lot of tax losses to harvest because the equity market's down over 20%. So firstly, should you take tax losses to generate those paper losses into real losses they can use for taxes? The answer is yes. On top of that, the idea of things like a Roth IRA conversion, the concept of going from, I'll just say, a traditional IRA to a Roth IRA, the idea is when will you have a lower marginal tax rate? If you have a lower marginal tax rate when you retire, then a traditional IRA works for you because all you're having for income is your distributions from your IRA, and you'll be in a lower tax bracket. However, most people don't think that's going to happen. And if you do basically an after-tax return of what you're in your IRA now that's pre-tax, because it's been a bad year for your investments, your tax bill for monetizing your IRA to an after-tax place ain't so bad. And if you think it's going to bounce back, by putting it into your Roth now, creating a Roth, when it recovers, you don't have to pay any tax on it.
Mm-hmm.
So it's a clever way to take advantage of what's been a tough year for investing.
Sounds like a good time for doing some conversions from traditional IRA to Roth IRA this year.
Exactly right. So, by the way, there's also a fear that Congress is going to basically take away the Roth IRA exemption, if you will. Who knows if that will ever happen, but there's rumors that that's the case.
Got it. So Mark, just speaking of numbers, these are obviously very technical things. There's no way we're going to go through each one of them on this call. But at the minimum, I'm hoping we can help our investors to ask the right questions. They ask their CPA, their wealth managers, how to deal with this, how to technically actually do a conversion, for example, how to actually contribute to a 529 plan, how to execute on tax loss harvesting and things like that. But just give us a ballpark. If they do everything on the list very diligently, how much tax dollars can I save?
Well, I can tell you from experience when I delivered this approach to McKinsey Partners. By the way, I didn't mention one other thing, I'll give you the answer. But in the U.S., there's two tax regimes. Your normal tax calculations that everybody knows about, but there's a second tax calculation that people kind of know about, but they haven't really been affected, so they ignore it, which is called the alternative minimum tax, AMT.
Right.
AMT was intended to basically make sure everybody pays some tax. So if you had really good accountants, really good tax planning, and the traditional way you didn't pay any taxes, Uncle Sam or the government would say, you know what, nice try, but you're going to pay me something. So that's why AMT was born. And you may or may not know how close you are to paying an AMT tax, but by doing what I just described at the end of the year, you'll know if you dip into AMT or not. But that's a second thing you have to factor in. And that's why it's good to do this exercise with someone who's a tax pro. But to answer your question, what's in it for me if I do all this stuff? When I did it for the McKinsey Partners, we estimated that this tax savings was up to 20%. And that's for people making seven-figure salaries. So it's meaningful. It definitely matters.
Definitely significant. And this links to the next point. Jerry, if you go to the next slide. So quickly running down the next few slides. And if people do have questions, feel free to post in the chat box and we'll address them at the end. So again, we do this type of education to help our investors to at least, at the minimum, ask the right questions, to start thinking about all these events, making our head spinning on the market and all these news and how to understand them, because there are so many noises. We advocate diversification. We encourage people to look at all the things listed on the slide, such as T&E planning, tax planning, insurance, etc., to really maximize their portfolio. Next slide, please. And not to repeat anything here, but just think about asset allocation and link that back to the macro economy and everything we've talked about here. And of course, we're going to do more of this kind of session in the future as well. And finally, our favorite question. If you go to the next slide, Jerry. Of course, stay in touch with us and feel free to reach out if you have any questions or if you need any help to ask the right questions to your financial professionals. But our favorite question here, which we always ask at the end of the podcast, is what are the key takeaways? And normally we name 3 of them. So Mark, what should our audience take away from today's session?
Okay, I'll give you 3, but honestly, we could make it 30 or 300 because this is such an important area with so many things happening. But clearly, one key takeaway, in my opinion, is invest for the long term. We're all long-term investors. Don't try to time the market, but make sure you have a sensible and logical asset allocation approach and stick with it. So that's definitely, in my opinion, one of the key takeaways. I'll just say tactical rebalancing of this portfolio that you've built an asset allocation around. The markets are volatile. Things are flying all over the place. So when your allocation gets out of whack, by rebalancing your portfolio, which is basically sell your winners and buy losers. By doing that, you basically take profits off the table and invest in things that are going to recover. So definitely, and don't overdo that. If things are more than 10% off your allocation, yeah, rebalance it. But if that's not the case, honestly, once a year it works, and dovetailing, rebalancing with tax loss harvesting end of year is a sensible approach, which really is my third point. So minimizing tax burden by doing the tax loss harvesting, doing the things we mentioned. Again, taking your prior tax return and just jotting down your current estimate of where you are now. Those aren't hard, difficult things to do, but man, they're very effective. They work. And I'm telling you from experience, having done it, that it's something everybody should do.
Thank you, Mark. That was great. I know we're running out of time, but we do have a lot of questions from the audience today. Let me just squeeze in one last one before we go. So in terms of financial crisis, can you just name a few protections and regulations that are helping to protect individual investors? What should people do to protect themselves with a potential financial crisis?
Well, firstly, after the 2008 financial crisis, which a lot of people don't even have knowledge or experience in, there are a lot of portfolio managers that are in their early 30s that didn't have to go through 2008 the way I had to, and other people on this call had to. So I'm bringing that up because they put safeguards in place to minimize the contagion effect of one financial institution failing and taking down the whole system. That being said, post 08, they implemented those rules and then they started diluting them. So we're not where we were. So we do have exposure, and keeping an eye on your counterparties and having diversification, that's always your best move. Never have all your eggs in one basket. And try to have the strongest and most stable counterparties you can have.
Great. Thank you for the sincere suggestions, Mark. And I thought this was a great session. I hope you enjoyed this conversation as well. And thank you everyone for listening in. We'll see you very soon.
Thank you, everyone. Have a great day. Appreciate your time.